Today's a special day on the podcast and my YouTube channel because I'm doing a mashup between the two. And if you follow me for a while, you'll know I have a podcast that's on Spotify, Apple, and a couple other places called Today in Tax Court. And Today in Tax Court is really about diving into current and some historical tax court cases to kind of pull out the best knowledge, right? This practical knowledge that you can only get a lot of the times from real life cases and mistakes made or even cases won. And so today we're actually talking about a tax court case. So it does feed into a lot of what I'm doing with the plug. This is the practical advice of the tax arm of helping small businesses, right? So how are you going to be able to take deductions? What's the character of income? Like all these things get thrown into a melting pot. And a lot of the time people sue the IRS over them because an auditor disallows the deduction or an auditor counts income that they didn't think should be counted. And so a lot of these are still relevant to small business. And so going forward, this is how I'm going to do it. If you're listening to this on the Today in Tax Court podcast, jump on over to YouTube. I have a YouTube channel. I'm talking about more than just tax court cases, but I'm going to start to bring these two together on a go-forward basis. So I hope you enjoy it. I hope you enjoyed today. Again, it's a real-life story. It's got some really important lessons. First of all, real quick identification. My name is Roger Ledbetter. I'm a CPA. I've been a CPA for just under 20 years in Texas. Primarily, I've always worked in public accounting, and I've worked on the audit side, auditing financial statements of private companies, and I've also then worked on the tax side for the majority of my career, the last part of my career. I have a lot of experience working with small business, privately held businesses in accounting and tax and structuring and planning. And so I always kind of approach these cases, court cases, from a real life example. And how am I going to advise my clients? How is it going to impact my clients? So let's jump into it. Let's learn the lessons from today. And what do we need to take away from this? And what's the tea? What's the juice that we get? Yeah, the thing I always say is no one ever really wins going to tax court because then you get drugged through the press or you get drugged through my podcast, right? If it's a good enough case. So the same thing goes here. So let's read about the tax court. We're going to talk today about this is a case of the Youngs versus Commissioner. And I'll give you the background of the case. So I'll have the case pulled up here, the main court decision up here. And I can post a link to the website if you guys want to see the actual court case, or just you can DM me and we can find it. So this came out earlier this week. And again, this is the Youngs versus Commissioner. And the whole premise of this case is about the ranch, a ranch that Mrs. Young bought with her previous ex-husband who passed away. Then she remarried. We're going to get into that. And so let me give you the background of the entire case. Then we'll talk about some of the tax issues at hand. And then we'll talk about kind of our lessons learned and how this all fits together. And so here's what happened. Miss Young used to be Miss Todd before she was remarried. But we're going to call her Miss Young. Miss Young was married to a business owner, and he owned an S-Corp, and they were in Oklahoma. And the S-Corp was involved in selling airplane parts. So I think they would refabricate airplane parts or repair them and then sell them. And it was very profitable. It was a profitable company. When her first husband was alive, her and her first husband owned that business. Well, I think he owned it 100%. And then when he passed away in 2011, she inherited and kind of took over, not inherited, but kind of took over his shares of the S-Corp. But also before he passed away, they purchased a ranch. I think they paid $2 million for a ranch. The ranch was named Pecan de Rosa. And on the Pecan de Rosa ranch, it was primarily bought as a pecan harvesting ranch, right? This was the whole premise, was that they had pecan trees, rows and rows of pecan trees, and they would harvest them and sell it. This is, I don't know the ag rules in Oklahoma, but in Texas, you have to sell product and things to get this ag exemption. So this is kind of the way that they were going to get their ag exemption, by selling pecans. There were some bad years with the pecans and harvest, and they didn't always turn out. Anyways, it was an 82-acre ranch from what I'm looking, checking my notes. 82.7 acres is what they bought. And primarily pecan ranches, but then they built and constructed almost a 23,000 square foot arena for barrel racing and like rodeo activities. And so Mr. Todd dies, and so Miss Young now owns the ranch and then owns the business. The business's name is ETI. And from what I can tell, we don't have all the details of the years, but ETI was a pretty successful business, pulling in something like, I think it averaged like $1 million a year in profits to her. The ranch, as one might expect, runs losses, constant losses in this, like, it's like they look back over like a 12-year period where the ranch is constantly running losses. At issue, and the only 2 years that were audited were 2013 and 2014, and these were the rules that these were the years that the Youngs challenged. What happens is the IRS comes in, they start to look at the ranch activity, because what was happening is the ranch was running losses and offsetting the ETI or the S Corp income, saving the Youngs taxes. This is only allowable under certain rules, right? You have to be able to substantiate that these losses that you're running are business expenses. Generally, they're ordinary, necessary. Also, that you're active in that activity or in that business, in that line of business. But even before you get there, the IRS kind of calls these four buckets. They call out 4 buckets of categories of expenses. And so if you look over my shoulder here, like this little section, like this is the income tax map. This is 2 years old, a couple years old. I bought this a few years ago and framed it because I'm that much of a nerd. But stays in my office. And so in it walks over like, this is like the gains portion. This is kind of ongoing income portion. And this far side is the expense portion or expenditure portion. So it talks about capitalization, amortization, but also deductions of expenses. And so in what the IRS auditor did was they took them to task, and I'll share this picture. I will upload it as kind of an attachment. I'll flash it on the screen right now if I can on the podcast. If not, I'll send out a post, a Twitter or X post this weekend. But it talks about these 4 buckets of expenses, right? And it needs to be able to fit into one of these 4 buckets of expenses before we can even talk about passive or active. So these 4 buckets are called 162. I'm going to use the code section name and then explain what they are. So 162 is ordinary necessary business expenses, right? So this is a trade or business is what the IRS would say. And these are expenses necessary to run that business, to make money. These are regular deductions as a part of running that business. Even within this, there are limitations, and we'll see this kind of carry in the other 3 buckets. But even within this, there are limitations. Like there's travel limitations, there's meal limitations, there's interest limitations now with 163J. And so within 162 is like bucket 1 of your types of expenses, right? And so what needs to be held is that for the Youngs, they needed to say that these were 162 deductions or 162 expenses. These were part of a trade or business, okay? The next bucket is then a personal expense. We can skip over this. This is like Schedule A. Generally, you can't deduct personal expenses except for Schedule A, which is, again, this is like charity, medical, subject to the threshold, the SALT cap, the SALT deduction, state and local tax deduction, mortgage interest expense. So, again, subject to more limitations. Those are personal expenses. The third one is then this ordinary necessary, but for income-producing properties or income-producing assets. So think about a rental. So if a rental property is not necessarily a trade or business, which a lot of them are, but if the rental property isn't considered a trade or business, under 212, Section 212, they allow you to still deduct very similar type deductions, right? So you're still going to have maintenance. You still may have some other rent that you'll have for this passive activity, this rental loss. So under 212, you're allowed to deduct those. And then the last bucket is a hobby loss or hobby expenses. This is not where you want to be because nothing is deductible under hobby losses. If it can be demonstrated that the expenses you're incurring for tax purposes are hobbies for a hobby, you lose deductibility. You cannot take any deduction for it, and it definitely can't be used to offset ordinary income. And so what was happening here was the Youngs were trying to say that A, this was 162 and So 162 being trader business deductions. And they said, but if not, then put it as 212 and put them as income producing asset deductions. But either way, that was their case. Their case was that these are not hobbies. They weren't personal expenses. They were related to a business, but it wasn't a hobby. This is straight to a business. And this is where the entire case is going to hinge. And so, let me get you the numbers, kind of some of the financials. So from ETI, let me look over. So this is over 14 years, had about $16 million of income. So this is averaging $1.2 million of income from ETI. Over that same period, the ranch posted losses of $2.9 million, almost $3 million of losses. So in that same 14-year period, the ranch was posting loss after loss after loss after. The ranch never showed a profit, allegedly, right? We're going to get into the fact that it didn't have accounting records for this, but the ranch never showed income. It had some income, but consistently net losses were always far outweighing it. And so what they did is over even these 14 years, again, we're talking, this is for a 2013, 2014 audit, where they only found these 2 years with like $100,000 of losses or $200,000 of losses each year. Over the course of 14 years, there was $3 million of losses that were used to offset ETI regular trader business income. And so the IRS comes through and the auditor says, no, we're disallowing this because we're going to consider it a hobby loss. The Youngs get upset. They sue the IRS. They take it all the way to tax court. And so here we have to kind of break it down. What does the tax court say? And so that's the background. That's the kind of the premise of it. It has to fit into one of these 4 buckets right here. You'll see the picture of it when I flash it. And so how do we do that? What is the historical precedent for determining are these hobby losses? And so this is a 183 case, a hobby loss rule 183 case. And when we look at 183 cases, usually they make reference to this like 9-factor test. So the courts have developed a 9-factor test to determine, are you in this for money or is this just a scam, right? Is this really a hobby for you and you're not going to ever really make money at this, and therefore it's not deductible, and certainly not deductible as an ordinary and necessary business expense. So let's go through real quick what the 9 factors are, and then we'll break them down one by one. So those 9 factors are, what is the manner in which you carry it on? Do you take it seriously? Do you have separate accounting files and records, right? Do you treat this seriously? How are you carrying on with this? What is your second one? What is your expertise? Right? Are you going into something brand new, or have you had a career in this, and have you had previous experience in this industry or in this line of business you're going to do? The third is time and effort. So we want to look at how much time and effort you're going to spend in this activity, right? If this is more than a hobby for you, you should be devoting substantial time and effort to this. The fourth one is then, what's your expectation of appreciation in the business assets, right? Do you expect things to appreciate? So this helps with like real estate. Like if you're not going to make money on real estate, because a lot of times with depreciation you're negative, but fine. Are you just in a longer business cycle? So what is your expectation of appreciation of the assets? The fifth is then success in similar activities. So they want to look at your past history and determine, have you been successful in the past? Have you done this before? Had a good exit, if you will, for real estate purposes, right? And do you have a track record of doing this before? The sixth is then history of income or loss, right? Have you made income in the past, or has it always been losses? The seventh is then amount of occasional profit. So even if you made a little bit of profit, well, what's the amount? Is it far outweighing how many losses you've made, or are you just funding this for deductions? Right? That's kind of the risk here. So going on to 8 is then financial status, meaning, does this help you? Did you get tax help from this, right? This kind of is the tell a lot of times, is like, what's your real motivation for doing this? And then the last one is then personal pleasure or recreation, right? So anytime that the IRS can get a hint of there's a lot of personal kind of commingling here, they don't like that. And so let's take these down one by one. So the first one was the manner carried on. And this is a test of, again, how serious you took this trader business. or this activity that you want to deduct, right? And so when we look at the Youngs in their case, during the years under audit, 2013, 2014, couple of no-nos. They didn't have a separate bank account. They used their personal bank account to pay for ranch expenses. And there were obviously ranch expenses and repairs and things you had to do. But step one, man, set up your own bank account. This is like step one for setting up your own business and to avoid this commingling. And even like from a legal perspective, like what business risk do you have if you don't have a separate business bank account? So they didn't have a separate business bank account, and they didn't have financial statements. They didn't have separate accounting records. They didn't have a QuickBooks file. Now in like 2020, right, then they eventually have a QuickBooks file, but who cares? This is not the years under audit. This is 13 and 14. And so right out the gate, it's not a good look. The other thing was that they didn't have a business plan. There was no written and saved business plan. What is the business plan to make money? If you're taking this seriously, you're going to have a concrete written business plan. Now, later on during the IRS audit and in preparation for the court case, they provided one. And it was backdated as though it was like at the date of the ranch was bought, but it was kind of struck down as, come on. It's a little too coincidental that you couldn't provide this during the audit, but now during the tax court case, you have it. And so, strike one really for the Youngs is that they didn't really take it too seriously. It wasn't treated like a separate business entirely and given a lot of respect. So factor two is now expertise. And the IRS or the tax court weighs this as neutral. So Mr. Young, again, her Ms. Young's second husband, was like a champion roper, I think. And so like the tax court memo even like makes note that like he wore like a championship belt buckle to the court case, which is just pictures a great picture of it. But she didn't have any experience. So he was experienced in roping and rodeo stuff, but not experienced in pecan harvesting and being a farmer. So now let's go on to the third factor, which is time and effort. And this is one that the Youngs win. And so the Youngs win this one because Mr. Young had quit his job. I think he was working in a church, and he quit his job to work full time. And so he was doing a lot of the manual labor. Remember, they were building this structure for more roping for a while. And so it was an 82-acre, 83-acre ranch. And so there was plenty of stuff to do day in and day out. And so he does win for his time and clear effort that he was working on the ranch. So again, that was the third factor for time and effort. The fourth one is now expectation of appreciation of the business assets. And this is, I say business assets like that because they made a really clear point in the tax court opinion that the appreciation of the 82 acres would not be a factor in whether or not this was a hobby loss or not. And the reason was that the Youngs had built their home on the 83 acres. And so because they had this personal kind of connection with this trader business, quote unquote trader business, the IRS said because it's too personal in nature, there's too much commingling there, we're going to say that there's no objective expectation of appreciation of the land as the business plan. Right? Again, there was no business plan, but as the business expectation, the land is not part of it. The appreciation of the land is not part of it. This is an L for the Youngs, right? The Youngs would have wanted to say that, look, this is a track record of income, because over the last 12 years, we've experienced appreciation in the land. The land has appreciated, and that should be counted as income in the business. This should help our case as income. Now, we had expenses and deductions against that, yes, but that'll give you credit. The IRS or the tax court disallowed that as a factor altogether, and they said only the appreciation in the business assets, which were really the roping stuff being done, the equipment for pecan harvesting, the pecan trees, like it was very minimal appreciation. And so they looked at that and they said, there's no real expectation of appreciation here. The horse, they sold some horses that made like $7,000 in 2014. Like there was very nominal income being made. And so clearly the $2.9 million of losses and losses every single year for 14 years was a bad look and a bad take. So the fifth one, so that favored the IRS. The fifth one is success in similar activities. And so this was neutral. So Mr. Young was only considered an employee of the ranch and not necessarily an owner or an employee of his previous line of work. I'm sorry, I'm misreading my notes. He was an employee for the previous line of work, and he had success in roping, but never really harvesting and running a full ranch or a farm. Mrs. Young's success with ETI was nothing to do with the ranch, like nothing to do with a farm, pecan ranching, or roping or anything. It was all related to an aircraft business, right, or aircraft parts. And so they called it neutral because, listen, he was roping. The court decided it was a neutral factor, and they wouldn't count it against him. So the sixth one now is then, what's the history of income or loss? And this one is pretty clear. It's an unbroken history for the last 14 years of losses. $2.9 million, $3 million of losses over 14 years since the startup phase, right? Since the start of the ranch, and they bought its losses every single year. All the expenses and all the detail that taxpayer gave to the court to look at were losses. Not great. So then the next was, that's 6. 7 is then amount of occasional profits. Well, this one again is easy. There was no profits. There was no occasional profits. We already know that the land got stripped out for appreciation because they had the personal residence on it. So you can't even use the land appreciation. The whole thing was a loss generating property, right? And so not a great look as well. Financial status, number 8, the 8th factor. So that was the IRS. The IRS, won on that one as well. The 8th factor is then financial status, and this is really looking at what's the why, right? What's the why here? And what's shown is that Ms. Young had the $16 million of income generated from ETI, but this $3 million substantially offset that. And there was a substantial tax benefit obtained from that $3 million. And so it's $1 million, $1.2 million a year. You're running income tax at the highest rates. And so call it 37%. I mean, throw in some state income tax effects to that, but 37% at a federal rate on $3 million, right? This is a substantial tax savings venture. And so it was determined this favored the IRS, that this clearly reeks of tax motives. And then the last one, the 9th factor, again favored the IRS, and this is personal pleasure or recreation. And Mr. Young had the belt buckle, and he had a history of being like a rodeo guy. And there were kind of nominal investments into a lot of what they were doing at the ranch to get into the business, but it was their personal home was on it, their personal residence was on it, and it was just not enough of a venture and a specifically business-seeking venture to give credence to the fact that it was legitimate. And so we have 9 factors, and if you kept count, if you didn't, that's all right. You kept count, 6 go to the IRS. And while it's true that a lot of evidence was offered in the court case, a lot of it was kind of circumstantial or kind of testimonial. So you had to take the Young's word about it, and weight weight is always given to the objective facts, right? What can be proven, what can be stated, what is documented, what is written down. And at the end of the day, the IRS ruled against the Youngs and upheld a 20% penalty. And so they owed, I think it was like $100,000 each tax year for 2013, 2014. What's going to happen? The IRS should immediately have opened up cases into other tax years. We're only seeing 2013, 2014, but in all likelihood, they're going to open up additional cases. Presumably, they've opened them up already for this to be decided. And so those are the 9 factors to determine what's a hobby loss expense. What do we do with this, right? What's the practical takeaway? What are the lessons we want to learn, and what do we do differently? If you're wealthy enough, like ETI level, Ms. Young level, and you decide you want a ranch, you just need to know that these are some very basic things you're going to have to do if you anticipate using ranch losses and expenses against your ordinary income. If you don't want the tax benefit, great. Buy the ranch, do whatever the hell you want. Don't open up a separate bank account. Talk to an attorney, but okay, fine. For tax, with the moment you start trying to use these for tax purposes, you just have to pay a lot more attention. You need your own bank account. Let's take it seriously. Even if you start your own business, a small S corp needs its own bank account. You need to be legit. You need to set up accounting records. Like, again, if you're going to treat this as a business for tax purposes, treat it like a business for normal person purposes, right? Take it seriously, right? Always then look at what's your expectation of income, right? What's your expectation of how this thing is going to make money? A business plan would be very helpful. And if not, even like a financial model, like, okay, this is the amount of investment we'll have here, but then here we'll break even, and then we'll start to make money, and then we sell. And give yourself a chance to make the argument that there was an expectation of profits. And then hopefully you want to start to show some income, right? This isn't a 2-year test or a 3-year look back test, and then you make money and it resets. This isn't that. Right? This is very facts and circumstances. Step back, look at it, and see what does this smell like? What does this feel like? And so in our case today, in the Young's case, it wasn't great. Right? All the factors kind of not all, 6 of them counted against him. The only one that helped was that he quit his job to work on the ranch full time. And so as a business owner, if this is what you want to do, right? You want to start this side business up and open up a ranch, buy a ranch, and use those expenses to deduct it. You have some work ahead of you, right? You should try to have an anticipation of profit or income. Otherwise, you're going to get thrown into hobby losses. Again, if you don't want the deductions, even better, buy the ranch, enjoy it. You're just not going to get a 30% discount on all the expenses and the deductions that you have. It's not just ranches, right? You're going to see this a lot. It happens a lot when people want to buy a plane, right? People want to buy a plane. The advice is usually buy the fractional, buy some timeshares. The amount of effort you have to use to evidence this plane as 100% business use, to take the full deduction for it, is just, it's a headache. The additional reporting that you have, federal purposes, is another headache. And then the recapture, even if you get 100% bonus, the recapture you take on it, a lot of times I've had clients who couldn't sell their airplanes because they couldn't afford the tax on it. That is never a spot you want to be in, right? So buy the plane if you like to fly. Fine, you want to fly, buy the plane. Who cares? But if the only reason you're going to buy it is for taxes, there's easier ways and cheaper ways to do that, right? Chartering boats is the same thing. You'll get someone who loves to boat, and I'm like, okay, now I'm going to use my boat, and I'm going to take clients out, and I'll be able to deduct it. There's a lot of things wrong with that, right? Like, entertainment is not deductible. The amount of hours you have to prove that chartering a boat is your full-time business. If you have enough money to buy a nice boat to charter, you're probably not working in a boat chartering full-time, right? This is not how it's going to work. And so you just see a lot of this. It's airplanes, it's boats, it's ranches, right? It's things that people like to do for fun, and they think, oh, I'll find a way to make this deductible. And it's just not necessary. So take the lessons learned. We'll stop it here. The lessons learned are take your business seriously. If you want to do any of these things, there's a lot of steps that you need to take to not get challenged. I will throw up the chart that's in the back here, the kind of section I took out of it. I'll throw it up on the screen. I'll put it on Twitter as well. Again, I hope you enjoyed it. I think this is a great takeaway case for business owners who are thinking about kind of taking their wealth to the next level and getting this side stuff started. Where to find me? The newsletter I send out every week is kind of where I spend most of my time. It's plug-newsletter.com. I have a lot of stuff out there on that site. You can go find it, peruse through my last postings. I'm on Twitter a lot, rledbettercpa. You can find me there. And you can find me at Plug Accounting and Tax. I'm on YouTube now, probably where you're watching this, or if you're on Spotify or Apple listening, come check me out over there. Give me a like. I'm just getting started. I would love a like and a follow. And we will leave it at that. Thanks.